Okay, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And there's a lot of questions here over the weekend and into this the beginning of the week regarding what's happening in the Chinese markets and how's that going to spill over here into the US market. So today we're going to take a look at all those things as well as take a look at the broader picture to see what our views are going forward. Before we get started, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So we'll start off with taking a look at the equity indices, and we'll take a look at the reaction, if you will, from equity indices to what's currently happening in China. And what you're going to see is that largely equity markets have shrugged all of them off. That doesn't mean that the risk can't be contained, will be contained. It could potentially spill over here, but largely I'll show you the charts, and I don't think that that's necessarily going to happen. But there are other issues that I do want to point out here with the US equity markets that I currently do see. We'll also take a look at some of the fixed income markets and commodity markets and how they're currently responding at the very moment. The sector rotation model update as to see the lack of rotation that we're continuing to see now, something that we've been bringing up for quite a few weeks now, taking a look at some of the economic indicators before sharing with you how we're looking for ideas in this particular market. So the primary question that I want to answer is the question that has been flooding my inbox here over the past couple of days around, are the risks in China spilling over here into the US equity markets? So my name is Tony Zhang. I'm the chief strategist here at OptionsPlay, and I want to share with you my technical research, my economic research, and my charts to help inform my decisions on some of these questions. So over the weekend, the Chinese regulators stepped up and published a document saying that how Chinese tech companies should be regulated, around whether or not Chinese tech companies should be allowed to be for profit. And what we have seen is stocks like EDU tank from about $6 or so down to about $2. So it lost a loss of about 70% of its value here in a couple of days. However, the one thing I will point out here for a lot of investors who have panicked, if you will, and asking all these questions, is that this is something that we have been talking about for months. For those of you that have joined me on my rapid fire session, almost every single time I get questions about Baidu, about Alibaba, those types of companies. And this trend is nothing new, because this is a stock that went from $20 to $6. So a loss of about 60 to 70% here from February. So this is not new. This has already lost 60 to 70% of its value. And the news over the weekend was kind of the final nail on the coffin. But it wasn't like this stock, was on a very clear uptrend, and all of a sudden the news came out and the stock has dropped 67% out of nowhere. We've been talking about the fact that Chinese regulators are continuing to crack down. This is not a good time to be investing in these types of stocks. And we're just continuing to see more and more of this. And I don't necessarily think that this is just the end, or this is the last bit of it. I think there will likely be more going forward. And Chinese equity markets have not been trading well. They've certainly pulled back and panic sold over the past couple of days. You see ARK funds selling Chinese holdings. You see money managers selling these types of holdings. But again, this should not be new information. This should not be a surprise to anyone. On the, I would say, positive side is that despite all of that, despite the fact that this has been going on for months, and that despite the fact that we had the news over the weekend, U.S. equity markets continue to be in a very strong uptrend, the opposite of what we're seeing here in Chinese equities or Chinese bonds. But one of the things that I do want to warn investors is that, we've been talking about this channel that the S&P 500 has been trading in. We're near the top of this channel here. Again, a few days ago, we were at the bottom of this channel. And one of the biggest concerns for me is that as we continue to trade in this very strong uptrend, we continue to see signs of negative divergence here. Weekly chart, higher highs in price, no longer confirmed by momentum. Same thing here over the past few weeks, higher high in price, no longer confirmed by momentum. So this is kind of the thing that we're seeing across the board: negative divergence across the major equity indices, the S&P 500, the NASDAQ 100 index. As we continue to make higher highs in price, we're no longer seeing higher highs in momentum. This type of negative divergence in itself does not mean you should go out there and short the markets. This is not these are just more alarm bells rather than signals to go out there and short the markets. But these are some of the more powerful indicators to let us know these are times to think about raising cash, moving some of your well-performing equities into cash, thinking about selling cover calls to collect some premium, maybe even sell some call credit spreads if you don't own a lot of 100 shares of stocks, to utilize and collect some premium that you could potentially use at a later date to buy some puts, to buy some premium, buy some portfolio protection if we start to see some acceleration to the downside. Could that acceleration be driven by catalysts such as Chinese regulation? Certainly, but I don't think that that's going to be the case because Chinese regulation has been cracking down for months. We're not seeing that type of risk spill over into U.S. equities. What is more concerning to me than what we're seeing here in China is really the fact that we're not seeing major equity indices participate in this equity rally. If you look at the small cap Russell 2000 index, very much in the middle of its trading range, not near the top of the range, starting to break out here to the upside. That would be confirmation of the equity rally that we're seeing here. We're not seeing that here from the small caps. We are seeing the Dow Jones break out to a new all-time high here yesterday, just a bit at a new all-time high since May. So that is starting to see a little bit of a confirmation here from the Dow Jones. But the one thing remember is that the Dow Jones is a 30 stock equal price index. So it's quite an odd index in terms of the methodology. There are some ways to skew this methodology. So this is something that we have to keep in mind. But the one thing I will say is that as Dow reaches new all-time highs, notice that momentum is nowhere near reaching new all-time highs. We're seeing it both on the daily and weekly timeframes here. So this is concerning to me as well. If you look at the RSP, the equal weight S&P 500 index has not made a new high here since early May. So again, what this is telling us is that the S&P 500 and the NASDAQ 100 are both skewed by the mega cap names in those indices. If you look at the S&P 500, the top 5 names make up 20% of the index. The top 5 names make up almost 50% of the index in the NASDAQ 100 index. Those 5 names out of the 500 and out of the 100 names are basically dragging the markets higher while the rest of the markets are not participating on the rally. That is not healthy for a market rally. We're seeing it in the evidence of the fact that Russell 2000 is not participating. We're seeing it in the RSP, the equal weight S&P 500 not participating. We also see it in the percentage of stocks that are above its 50-day moving average. That's currently trading at 36%. If you were looking at just this metric alone, you would think that markets were pushing new lows. But no, we're pushing brand new highs, and only 36% of stocks are really participating in it. The other 70% of stocks are trading below its 50-day moving average. These are signs that things are not all well in the equity rally that we're seeing. You know, we look at the S&P 500 and the NASDAQ 100, and they're pushing to new all-time highs, and you're thinking to yourself, great, equity markets are doing great, let me keep buying. But if you look underneath the hood, things are not particularly well. We've been mentioning this for weeks. We started to see a bit of a reversal here 2 weeks ago. Things were starting to improve a little bit. We're starting to see some of the major indices test new highs again, are about to break out to new all-time highs. But guess what? That has reversed again. The health of the market rally has started to continue to deteriorate over the past week or so as we started to say that things were looking a little bit better here, but we'll continue to track it. Instead, unfortunately, things have gotten worse. If we look at the government bonds, U.S. 10 years, so far finding a bit of an equilibrium here around 126 basis points. So we touched that here in July here, or in early July, traded all the way as high as 143, went as low as 112, but we're back up to about 125 basis point level here. So taking a look at TLT, what we have seen is this very strong uptrend here in TLT, finding a bit of an equilibrium here around 148 or so. And what we're doing is we're watching this trend line. If we start to see a break lower below that trend line, that could send yields higher, that could send equity valuations lower. This is really the break that we're paying attention to. So far, we haven't seen that break, and our view is that TLT or government bonds can continue to rally here, and yields can continue to move lower, and and equity markets can continue to get stretched even further before kind of the rubber band breaks. But we're starting to see a lot of these signals, a lot of these warning signals that we need to pay attention to, despite the fact that we are clearly very much in an uptrend with respect to equities. When we look at the dollar index, we've seen this $93 resistance level here on the dollar index so far holding, but we're seeing the same type of negative divergence here on these new highs, higher highs in price, no longer confirmed by highs in terms of momentum. So this is perhaps showing us potentially a potential weakness here in the dollar going forward here. So what we're really watching for was we need a clean break here above 93 to head us back towards the 94.5 and potentially even 96 level that we're back in prior to the pandemic in order to resolve this negative divergence here at the moment. And one question that I have been getting quite a bit here is Bitcoin, 30,000, 40,000. This is the range that we've been trading in pretty much since mid-May. And we've had multiple attempts at 30,000 that have held, multiple attempts at 40,000 that has held, including yesterday. So we're very much still in this range-bound consolidation after what has been a very strong move here to the downside. Now, the question is whether this consolidation will be a continuation back down, or will this be the consolidation that it needs to break back towards into this $50,000, $60,000 range that it was trading in prior to this particular sell-off. So this is really where we look at a bit like the fundamentals here. There's some rumors that Amazon is going to start taking Bitcoin payments sometime in the next year or two. That certainly would be a very large, I would say, vote of confidence to using Bitcoin as a form of payment, which is the one thing that it currently lacks as a currency. A currency needs to be able to store its value and allow you to buy goods with it. And right now, both of those things are not true at the moment. But we're certainly making developments towards that. Will Bitcoin ever get there? That's the question for a lot of investors, especially long-term investors such as myself. But these are the types of ranges that you want to pay attention to. If we get a breakout here above 40,000, that's going to be fairly constructive for a resumption back into the $55,000, $60,000 range here to the upside. And then the sector rotation model. This is something that we track every single week. And we've talked about the fact that there's been a lack of rotation for a long time. We started to see a little bit of rotation happening last week here. But unfortunately, that rotation that we started to see last week is really starting to reverse here again. So we're really, again, going back to is just seeing these few sectors, technology, consumer communications, discretion, and healthcare back into the leading category after spending maybe a week out of it. And then all the other weaker sectors are weakening again here again. Materials, financials, industrials, staples, is moving a little bit here, is improving a little bit here, but my hunch is that they're going to start to roll over here as well. So when we look at the sectors here, looking into the sectors, we continue to see more negative divergence. Some of the concerns that we saw here in the equity markets, we're seeing in the major sectors here as well. If you look at consumer discretionary, multiple months of divergence here on the weekly chart, on the daily chart, same thing. We're starting to see divergence form on the daily and weekly chart. When you see these two line up on daily and weekly charts, that does provide a slightly, I would say, more powerful signal. When you see this alignment of negative divergence on daily and weekly charts, that really shows you that there's poor setups and there's exhaustion on multiple time frames. That could lead to just a larger sell-off here when that catalyst does emerge. What is that catalyst going to be? I unfortunately can't tell you. I don't think anyone else necessarily can. But what we really need to do is pay attention to these warning signals, because the more these warning signals flash, the more aware, the more sensitive you should be to what could drive, the next catalyst or drive this equity markets lower. We're seeing this in technology here as well. Higher highs in price no longer being confirmed. We're seeing this on multiple time frames here for technology here as well. Higher highs in price no longer confirmed by higher highs in momentum. And then the last one I want to take a look at here is industrials. We still have this, the Senate trying to push through an infrastructure deal somewhere in the $500 to $700 billion range here. That certainly, if pushed through, would certainly be very positive here for industrials. So I would pay attention to this sector at the moment, trading fairly strongly, I would say, compared to some of the other sectors. Forming a bit of a base here, forming a bit of positive divergence rather. So it's basically the opposite of what we discussed here: lower lows in price, higher price and momentum. This leads to a potential a continuation higher here, especially if we can break above 106. So there's more fundamental reason behind, the XLI rally that we're starting to see here at the moment. And then when we take a look at the economic side of things, housing numbers recently just came out. And this is really where we saw the past couple of months of housing starts that have eased continue to ease, and the housing inventories that have started to rise continue to rise. So this is likely starting to put the housing trade towards the end of the housing trade, if you will, if we continue to see this trend in this particular direction next month. But I would say that, 3 months in a row, that's starting to show us a trend. As inventory levels start to climb, as home sales start to decline, that's going to put a little less pressure on the home builders. That's going to potentially put the strength here of the home builders and the home construction stocks probably here at an end. Some of those stocks have been the best performing stocks throughout the pandemic. And I think that we are now at the point where that trend has largely ended. So if you have some of those names in your portfolio, those are ones that you might want to start paying attention to, or maybe starting to think about taking some profits on those positions if you've had those for a while. So as you look for opportunities here in this market, this is really where it's quite tricky. It's hard to say, I would say, to try to find bullish opportunities, and it's also hard to find bearish opportunities in this type of market, because as you trade to new all-time highs, your first instinct is look at bullish opportunities. We're clearly in a bullish trend, and there's no doubt about that. But when stocks are either near all-time highs and you don't want to chase those all-time highs, or some of the stocks that you're looking at that are strong but are not trading so well, those are the ones that you're not sure, are these going to continue to trade? Are these going to resume its bullish trend? So this is really where you have to look at a combination of technicals and fundamentals. And one stock that really jumps out at me is Citigroup. Citigroup, one of the strongest financial institutions actually, but if you look at the stock, you wouldn't think so. But one thing I have identified here for Citigroup is the opposite of what we're seeing here in the equity markets. We're seeing positive divergence. As price trades to new lower lows, we're starting to see that momentum indicators are no longer confirming those lower lows and actually showing higher lows. So this is what we call positive divergence. This is basically the opposite of what we're seeing here in equity markets. And then when you align this with the fundamentals here of Citigroup, out of the major banks, Citigroup's, especially as yields find a little bit of equilibrium around 125 basis points, if we start to see rates stabilize and potentially even start to rise, that's going to provide support here for names like Citigroup. So when you have a name that has pulled back quite a bit here from that $80 high down to 65 here or so, finding a bit of a bounce here, and if we see a break above that 21-day moving average, that would be a pretty strong signal that the downtrend here has ended and that we're going to likely start to resume that uptrend here, especially as things recover. These banks are the ones that you want to take a look at. They're not trading at rich valuations. They're trading at very reasonable valuations. And these are the risk to reward ratios that I feel far more comfortable taking long positions here in this type of market condition than trying to chase some of these high flying stocks at all-time highs, hoping that they'll continue to trade even higher, which again, like I said, this is starting to form a very unhealthy market the way that those stocks are currently performing. and to take a look at some of those stocks that are performing that way that may have some downside risk here. This is really where we turn to two of these sectors that have remained in this very strong upward trajectory, continue to trade at all-time highs, trade at kind of overextended, trade at very rich valuations. One of these stocks that I want to point us here is Costco. Costco has had a very strong move here from 310 to 423. And this is during a time where there's virtually zero revenue growth, zero EPS growth for this particular company. And it is very overextended by pretty much all measures. If you look at the weekly chart here, we have a new overextended RSIs now above 70. Very rarely is this stock above 70 on RSI. So very much potentially at a reversal period, if you will, here. And if you look at the daily chart here as well, what we're starting to continue to see is higher highs in price, no longer confirmed by momentum here. And again, this is really just a stock that has kind of decoupled, if you will, from the fundamentals, where you've seen zero revenue growth, zero EPS growth over the past 3 quarters, yet we're seeing the stock rally substantially, a bit of decoupling, if you will, from the fundamentals. And this is really where I think, if you're in this particular stock, these are great times to consider taking profits or selling cover calls. If you're not in these stocks, selling call credit spreads potentially are a better way to play this, limited risk ways. Always whenever you're shorting a stock or thinking about shorting a stock or using a bearish view on a stock, use limited risk strategies using options. That way, if this stock does continue to power higher here, which, in these types of stocks, you could have potentially had that same idea over here. Perhaps you had the same idea over here. And if the stock continues to power higher here, you are limiting your risk to the upside. Even if the stock continues on to 450, 470, those are your, you want to make sure that those, if that happens, you have limited risk to the upside. Another name that falls into this category here is ROKU. ROKU has been one of the best performing stocks since the pandemic. It rallied from, what was a $75 stock up to a $480 stock. In the span of just about a year or so. So, you're talking about a very strong move here to the upside. And after pulling back down from that 480 to 280 or so, it's rallied all the way back up to 480. And the question is whether this continues to move higher here or not. And when we look at the revenues, we've already started to see revenue decline here on ROKU. So the fact that we're trading back near towards all-time highs with revenue declines, EPS is starting to grow here. That is certainly constructive here, but that revenue decline is really what I'm most concerned about. And you have this kind of double top feature here, double top with negative divergence on both daily and weekly timeframes as you make higher highs in price, lack of momentum here on the daily side, on the weekly side. Equal price, lack of momentum here on the weekly chart. So that leads me to believe that you could see more of a sell-off here. ROKU does report earnings here soon. So that is a potential catalyst that could drive these rates either higher or lower here. But that's really kind of where you're taking a bet as to which way it's going to go, based on the revenue numbers, based on, the technical factors that I'm seeing. My hunch is that you're going to see more of a decline. But like I said, for those of you that have watched me take earnings plays here, the most important thing that you do with earnings plays is not what directional view you take, but how do you limit your risk if you're wrong. Earnings is risky. Earnings is volatile. You can potentially make a lot of money if you get the directional view right. You can also lose a lot of money if you get the directional view wrong. So make sure you use strategies in this particular case, such as selling a call spread or buying a put spread, where what you're doing is you're limiting your losses if you are incorrect on that directional view. But these are the ways that I'm currently looking for opportunities here in this market. Are stocks where the revenues are no longer growing. These stocks have had a very strong run, but revenues are starting to decline. Trading technically fairly poor, near some type of resistance level. Those are the ones that have the highest probability of a pullback. That's the type of opportunity that I'm currently looking at in the few selective bearish plays that I am making here in the broader markets. Because again, look at the broader context. We are very much in an uptrend. Even though there are warning signals, even though there are alarm bells sounding, we're still very much in a bullish trend. You have to respect that bullish trend. So keep that in mind as you're thinking about how do I position position here in this broader markets? How do you look for bullish opportunities? How do you look for bearish opportunities? Here are some of the ways that I am doing that. So with that, thank you so much. I hope that this was helpful in giving you a better understanding as to what happened over the weekend. Is that spilling over here in the US in the broader sense? And the answer for me is largely no, but there are a lot of other issues that I see here in the US equity markets here at the moment that I think are worth paying attention to. So thank you so much for joining me. I hope that you'll join me here next Tuesday as we continue to monitor these things that I'm referring here to today and giving you an update as to how they're continuing to develop next week. With that, thank you so much. I hope you guys have a great trading day, and I'll see you guys here next Tuesday.